Hello everyone. In this playlist, we'll be exploring cost functions as part of our understanding of producer behavior. So let's dive right into the chapter. So what is a cost? Well, we all know that the word cost here refers to how much money it would take to produce something. How much money does it take to convert a certain set of inputs into something tangible, into some output? Now, why are we asking this very specific question of what is a cost in the beginning of the chapter when most of us know the actual meaning behind the word? Well, there's a very specific reason for that. And that's because the term costs, as we traditionally know it, comes more from an accounting perspective. When we think of costs, we generally think of out-of-pocket expenses, maybe depreciation on some asset that we've bought. So we generally tune to thinking of costs in an accounting sense of way. But as economists, we also have to think of costs in a slightly different way. And economists generally think of costs of anything in terms of opportunity costs. So, specifically speaking, opportunity costs refer to the cost of opportunities that are foregone. So, if I choose to produce a particular object, then I am choosing to give up the production of something else that I could have produced with the resources in hand. If I'm choosing to invest my time into setting up a startup, then I'm choosing to give up something else that I could have done with my time. So, this opportunity that is foregone is called the cost of that opportunity which is lost or foregone is called opportunity costs. So, economists have this way of thinking about different resources that are used in production in terms of their opportunity costs. And that's why we're learning of this distinction right in the beginning of the chapter. So, specifically speaking, in the context of cost functions, accounting cost will refer to any out-of-pocket expenses. Economic cost will refer to the opportunity cost of that input. Specifically speaking, it refers to any money, any payment that you would have to give that input to keep it in its current place of employment. Any payment that you'll have to give the input in order to compensate for what it is losing, in order to compensate it for its opportunity cost. So that the precise definition is that the remuneration that the input would receive in its alternative employment. So to give you a few examples of how common resources, typical inputs into the production like labor and capital and the entrepreneur services, how do economists and accountants see this? Turns out labor cost. So whenever you're hiring laborers at a certain wage rate, maybe there is a going rate in the market. Maybe somebody who is a wage laborer is supposed to be paid, say, 100 rupees per hour or 200 rupees per hour. So in that case, labor costs are generally the number of labor hours that your workers put in times the going wage rate per hour. So that would be an out-of-pocket expense. That's how the bookkeeping entries would be made. And that is pretty much how economists think of labor costs as well. Because if there is a going wage rate, if I am a factory owner and if I am employing laborers by paying them 100 rupees an hour, another factory owner will also be employing and paying laborers at the same market wage rate. So whether the laborers are here or elsewhere, they're going to get the same wage rate. So what I pay them is what they would be getting in an alternative employment as well. So the opportunity cost definition and the accounting cost definition work out just perfectly here. The differences start coming in terms of how capital and, say, for example, entrepreneurial services are treated. So, for example, if you take an asset of, say, a computer that is worth about 1 lakh rupees, an accountant would treat it in a way where the cost of the asset is 1 lakh. The life of the asset is, let's say, 5 years. So the asset is going to depreciate over a period of time, and at the end of the 5th year, it's going to become obsolete. So what the accountant will do is take this 1 lakh and spread that amount over the life of the asset. So that's how the accounting perspective will treat this cost. How the economist would look at it is that this investment that I make into purchasing the computer, that money, that 1 lakh is gone. That is going to be sunk cost. I can't recover that money anymore. But once I have the computer in hand, is there some alternative use that that computer could be put to? Maybe I could rent that computer out to someone else and make some money off of that. So this sort of a cost, this sort of whatever payment that the asset will earn in an alternative employment, that would have to be factored into my economic cost calculations. So that's how capital would be seen. If you were to think of entrepreneurial services in the accounting sense, there is actually no specific cost associated with the entrepreneurs because they're just the residual claimants of any profits that are left over, any accounting profits, revenues minus costs, whatever is left over goes to the entrepreneur. Whereas with the opportunity cost definition, an entrepreneur is spending their time and energy into setting up this particular company or enterprise, and they need to be compensated for that. If they were engaged in another venture, putting all of their skills to use, they would have been paid a certain amount of salary. So that salary, which they will make somewhere else, will become their opportunity cost here. So the economic profits of the firm will also account for all these types of opportunity costs. So the economic profits for that reason may actually be lesser than the accounting profits. Because accounting profits is just revenues and costs. You don't account for any opportunity costs. Anything that you account for over and above your accounting profits, that goes into your economic profit calculation. Now, accounting cost data are very readily available, so it's very easy to compute each of these heads, whereas opportunity cost data is not very easily available. That is something to bear in mind. Now, in the rest of the chapter, we're going to be spending a lot of time analyzing how firms deal with their cost functions, what is their goal with respect to, we'll learn that their goal is primarily one of cost minimization. And we'll spend a lot of time on that. So before we get into that, we're just going to make a few simplifying assumptions that we'll deal with. In this chapter, we're only going to be looking at the case of two inputs, labor and capital. And we're assuming that we're dealing with homogeneous labor and homogeneous capital, meaning every single unit of labor is identical. Every laborer that you hire is identical. Every piece of capital equipment that you hire is also identical. And that's the meaning behind the term homogeneous. And for simplicity, we're going to assume that entrepreneurial costs are included as part of the capital costs. Another quick notational overview here. We're going to call the price of labor, we're going to denote that using the letter W. W can stand for wages. The price of capital, we're going to denote that using the letter V. That just indicates the rental rate of capital. So that is one assumption. And we're also going to assume that these inputs, labor and capital, are hired in what we call perfectly competitive markets. So these are markets where whatever is for sale is available, whatever is being sold in the market is available in abundance, and every single unit is identical to another. So in such scenarios, what happens is that every unit will sell for the exact same price in the market. So the best example for perfectly competitive markets is, say, market for fruits and vegetables. So if you walk into a street where every single stall is just selling fruits and vegetables, you will notice that tomatoes generally will sell for the same price in the entire street, assuming that they're all perfectly identical and of the same quality. Mangoes will sell for the same price, so on and so forth. So we are assuming here that labor and capital, because they're all homogeneous and identical, they are being sold in these perfectly competitive markets. Or rather, the firms are hiring these inputs from such markets. And in that case, in such scenarios, any single buyer or any single seller will not have any control over the price of the good. In the fruit market scenario, you or me who walk into the street will have no command on what the price of tomatoes would be, or what the price of, say, grapes would be. So there's a going rate in the market, everybody just takes that price is given, and transactions happen at that price. So anybody who deals in that market will be called a price taker. So what this means in our cost function scenario is that inputs that hire these labor and capital units of labor and capital have no control over the price of labor and over the price of capital. They're going to treat the wage rate and the rental rate of capital. They're going to treat W and V as given, as exogenous parameters, and make their decisions with that. And the next point is just a technical point, which is that any good that is sold in a perfectly competitive market will have a horizontal supply curve. I'm not going to go into detail there. We'll cover that later in perfect competition. And a final feature of what we're going to be looking at in this chapter, we're going to be dealing with cost functions. And given that costs are primarily going to come from labor and capital, the overall cost will come from the total bill that I pay for the laborers and the total amount of expenses on capital. So if L is the number of laborers and W is the per unit price of labor, W times L is the cost of labor. Similarly, V times K would be the cost of capital. So this is how I denote my cost function. My revenue function is just going to be prices times quantity, P times Q. And Q is given by f of K and L, that's my production function. So I can write down my revenue function also. And once I have costs and revenues, I can write down my profit function. I'm writing economic profits here because we're dealing with economic costs. So when I compute the profits, turns out the profits are given by this particular expression here. And we can clearly see that the profits of a firm now certainly depend on the amount of labor and capital that is being hired. So if I were a firm and if my goal were to maximize profits, I would probably be looking to see how much of labor and capital I should choose in order to get as much profits as possible. But notice that how much of profit I'm making also depends on how much output is being produced. So if I were to choose K and L to maximize my profits, I also need to figure out how much output I need to produce to get there. And that is a little beyond the scope of this chapter. So we're now only going to focus on, we're not going to focus on profit maximization, but rather we're going to focus on cost minimization. We're going to be working in a scenario where we assume that the output level has already been chosen. So for a given level of output, we're going to figure out how much of labor and capital to hire so that you can produce that fixed level of output at the lowest cost possible. So that's going to be our goal for this chapter. So I'll see you in the subsequent videos.